more analysis is Betsy Duke, former Fed governor and former chairman as well as Fargo, as well as Ken Shinoda, a portfolio manager over at DoubleLine Capital. Betsy, let me start with you. The if was really key. What's the data going to be that if everything keeps going okay?
So exactly. It is if things were going in the same direction that they are right now, I think the Fed is pretty happy with that, and they would consider that that would be longer than just 1 quarter of data in that direction and probably be ready to make the first move.
This gets us to a question, Ken, here. What are the implications for that? If we do end up getting that here, are we talking about a weaker dollar, obviously potentially a weaker, a lower rates here, but what is kind of the moves that we see in between?
Yeah, I think you could see a little bit weaker dollar on that move, especially as some of the other currencies around the globe, like the yen, potentially appreciate. You saw this morning that the BOJ came off at zero after decades plus, long time down there. And then the short-term rates are the most poised to fall as the Fed normalizes interest rate policy. So that front end of the curve we expect to come down meaningfully as they start normalizing policy.
Betsy, the statement sounded pretty hawkish, and then during the news conference, he was much more specific and said September a number of times. So what exactly are they waiting for? Is it waiting for the sake of waiting, or is there, a specific data point when it comes to unemployment or when it comes to inflation that they need in order to get that confidence?
So first of all, I'd be careful about counting the number of times he said September, because you also have to count the number of times they asked him about September, and he answered about September. So I think it's more that they need more data that looks the same, and a sense that the data is going to stay the same. And I would also caution that the first move doesn't necessarily mean that there is a race to normalize. It means the first move. But there's still a fair amount of uncertainty out there. In addition to normal uncertainty, you have the uncertainty of an election year, which is uncertainty for economists, for businesses, for consumers, for everybody. And then remember, in 2025, you have the certain expiration of the Trump tax cuts. So even no action is going to be a pretty strong effect on the economy.
Yeah, that's right. Several is what Powell said. I don't really know what several winds up meaning. Hey, Ken, if I'm looking at the bond market, what's my several? Like, if I look at the 2-year, is several 3.5% on the 2-year? What is it?
Well, right now the bond market's pricing in about 2 to 3 cuts, probably 3 after today's move in rates lower. And the terminal rate expected by the market is kind of around 3.5. But I agree in the sense that they are very data dependent. They got finally some relief on shelter inflation on the last CPI print. Shelter inflation really lags kind of the broader market indicators that we look at in the real estate market. Rents have been coming down meaningfully, and finally that moved in the last CPI print, and I think that gave them a little bit of hope. But what they really want to see, I think, is that they want to see the employment components of the in the job markets continue to weaken and slow down. They want to see that quits rate continue to come down. They want to see the job openings continue to come down. I think they want to wait to get a more meaningful signal that services inflation will remain low, and we won't see a reacceleration of that.
It's an interesting point that Ken brings up there, Betsy, particularly on the services inflation. Bill Dudley kind of made an interesting comment about how the Fed's own internal inflation metrics are probably a lot closer to 2%, to the point of it almost being a rounding error at this point. And the idea that if we start to see those other metrics, the more forward-facing ones, also move down there, it raises the question as to whether the Fed is already behind the curve. Do you buy into that argument?
I don't think behind the curve, and I think appropriately cautious. And it is services, but in addition to services in particular, it's housing. And I think housing is going to take a lot longer to come down and stabilize than anything else, because you just have such a shortage of housing and have had for decades.
You know, we've got a lot of jobs numbers coming up in the next 2 days. You've got, the ADP stuff, or in the challenger job cuts, and of course then you have the actual jobs report, Alex, that at this point, is it as market moving as it would have been 2 days ago?
Well, I don't know. I feel like Jay Powell made that very market moving, Betsy. I mean, I feel like you put a lot of emphasis on that jobs number in a big, big way. What are you going to be looking at? What do you think we're going to get?
Well, first of all, jobs numbers are frequently revised as many as 100,000. So to move markets on a single number, it seems insane to me, but that's the way markets go. Also, markets tend to, quite rationally, try to determine where they think the end point of Fed's moves are going to be. So today, now there's an expectation for 3 cuts. I read the Fed as much more cautious than dashing out with 3 cuts before the end of the year.
Oh, interesting. So it gets to a question here, Ken, when we start to talk about whether the data is going to be supportive of those cuts, that Jay Powell alluded to, cuts that the market is pricing in here. How much is that going to change longer-term positioning in the fixed income space? And I guess basically what I'm talking about is for someone like you who's kind of a short-term duration guy by, I guess, job title, do you think you'll see more of your peers extend duration?
I think a lot of people have already extended duration into the backup that we saw into the fall of last year, maybe here when we got back up to 470. So I think most bond managers have extended durations to close to the longest that they've probably been in over a decade, just given where, how high absolute yields are. We've seen a pretty good run. I think the market is pricing in a lot of this softness and or easing into the marketplace, and usually you'll probably see a little bit of reversal. We saw that at the last Fed meeting. We had a good CPI print. The market kind of rallied into that and then kind of backed off a little bit, about 20, 25 basis points. I think we've run a little bit too far, too fast here. I wouldn't be surprised to see a little bit of a pullback. Could be a good buying opportunity for investors looking to add that duration into their portfolios.
I'm looking at the 2s10 spread, Ken, and the yield curve steepening just a bit today after that 2 p.m. announcement and, of course, during Powell's comments. What does the shape of the yield curve look like to you until September?
Well, I think we'll stay kind of this slight inversion. Maybe we can flatten out. I don't think we're going to see too much more steepening into September. I think the market really wants to see that cut actually happen as opposed to just the threat and the talk of it.
Yeah, no, fair enough. All right, Betsy, before we let you guys go, a final word. How do you think Powell did today? Do you think he got the right message across in the right way?
Yeah, I actually think this was one of his better press conferences. I think he was cautious not to lead markets too far down the path to lower rates, but he acknowledged that was the discussion that was teed up for September.
All right, Betsy, always great to talk to you, as well as Ken as well. Betsy Duke, former Fed Governor, Ken Shinoda, portfolio manager over at DoubleLine here on this Fed Day.